How important is it for the brokers to offer low latency as a differentiated service? Is it a differentiated service, or is it increasingly becoming a commodity? So the first thing I'd like to ask Neil and Hans is whether they agree with that statement, whether low latency is actually now a commodity, and if so, how can brokers differentiate themselves, given the fact that the markets are becoming more and more automated? So Neil, if you could maybe start.
Sure. I think the one thing to realise is that low latency as an advantage really is only an advantage when you have a lower latency than somebody else if your algo is doing the same thing. So there's no good having an ultra low latency link if someone else has got an ultra low latency link. You don't gain a particular advantage over that guy if he's doing the same thing with the same algo. So is it becoming a commodity, or is it becoming defunct? It's low latency today is the norm of tomorrow. And that's what we're seeing now. Everybody's pushing low latency. Everyone buys low latency. Suddenly nobody has that advantage anymore. There's no arb in the technology anymore. So I think the costs are being pushed up, the advantages are being taken out, and everybody's costs just go much higher. So yes, it's becoming a commodity, but it's also losing the advantage of what it originally had.
Hans?
Yeah, I think, first of all, brokers have different business models. So you need, as a broker, you need to clearly define in what segment you want to be. And there are clients who ask for, millisecond, microseconds, or below potentially latencies, and there are clients who are just not that speed sensitive. So there's variety, and all of them could still fall on the bucket of high frequency trading because they do hundreds of thousands of trades. So even within these high volume clients, you have very different kind of latency demands, and brokers, of course, need to decide where do they want to position themselves. And amongst the bulge bracket firms, I do think you can see, there are a few who have focused on that and have services which, in the current generation, offer you a single-digit microsecond latency. So there's a small group of that, and then there are prominent names who are missing there as well, who have like a different sweet spot in their services, or because they're smaller and just can focus on one thing. I mean, low latency technology, cutting edge, doesn't come cheap, right? You do need a substantial client base to be able to make money, and then I think it's also important to realize it's regionally very different, and actually the size of the market opportunity from a broker point of view, kind of the number of exchanges, right? In Europe, we have many markets, and low latency technology means something different in each of them. In the US, you have a big concentration on a few big exchanges, and many more market participants and revenue opportunities. Regulation is another important factor. In Europe, it is relatively simple, I would say, to obtain your own membership. You don't inherit big regulation, at least not so far. Mm-hmm. Completely the opposite in some Asian markets, and still much more regulation you inherit if you want your membership, at least in equity markets in the US. So that also drives the brokerage market. And as you can see in Europe, in a lot of the high frequency trading firms, and if people want a list, the easiest is always to go to the Nordic market statistics because it's very public there. They have their own membership. They don't come through brokers.
Okay.
Yeah. So they still need a clearer, so they still come to Neil. They don't need an execution service provider.
Yeah. Just on the topic of regulation, in the US, you've got this rule, SEC, I think 15C3/5 is the so-called market access rule, which is requiring firms to have their order flow going through pre-trade risk checks before they hit the market. Is that generally slowing down order flow, or are there ways to enable the order flow and the executions to go through while still implementing that rule? How much impact is that having on latency?
I think it depends very much on how you interpret the rules. And I think one of the things that we've seen, certainly with that particular ruling, is that there's a fairly widespread interpretation of what the rule means and how people actually adhere to or try to adhere to that particular set of requirements. Does it slow the flow down? It depends on the technology that you've already got in place. I think it depends on the checks that you interpret that you need to place on that order flow. And I don't think it needs to. If your risk model is such that you've already got a good financial risk model in place, you've already got a good compliance risk model in place to make sure that you're not already in breach of exchange rules, then it doesn't need to slow that flow down. The problem you've got is where you've got members out there who have very few risk controls, very lightweight risk controls, and now they're being forced to put layers on top of that, then yes, that will slow the flow down. One of the things I think that we're seeing now is that the regulators are speaking more to the trading venues, to the trading members, to the clearers, to the technology providers, which is a good thing, which is something that we've been looking at them to do for a long time, and to actually find out from them what is possible. Because I think a lot of the time that you get a regulation that's put in place, which is potentially ill thought out, well-meaning, but ill thought out. The overall considerations of a global market aren't taken into consideration when the rule is actually devised. And it actually becomes almost impossible to implement, which is one of the things that we saw with the rule on the 14th of July. Part of that was actually taken back before implementation because they realised that it wasn't practically possible to implement all of that rule that came out. So if you've got cross-border, cross-market share on particular stocks, if you need to aggregate the risk position of a particular company, then the technology has to exist to be able to facilitate that. If that technology doesn't exist or isn't possible, then you've no way of implementing that rule. So I think the good thing is that we're now seeing the regulators speaking more and more to the technology providers, to the trading members and to the clearers to say, well, what physically can we do? What's reasonable to ask people to do? And at that place, it shouldn't slow the flow down. So yes, it can slow the flow down depending on your existing model, but you don't have to cause that impact. I think the other way that you can look at the risk model is by making it standard across the board. If you standardise the risk model at the exchanges, then you don't need to slow the flow down in real terms because everybody's seeing that additional latency. So it still becomes a very fair playing field.
I would agree with that, and we have examples in Europe. Probably the leading, or in time, and maybe technology. Well, let's say in time, the leading example was BETS with their sponsored access model, which is, other than the US one, which just has disappeared. Which still, like, for a lot of like US people, are still amazing that we now kind of create all different sorts of sponsored access models in Europe, whereas it just disappeared in the US. So these kind of risk-controlled sponsored access models, or sponsored DMA, or the kind of new words out there for it, do the risk checks on the exchange side. So, very close to the matching engine, if not embedded somehow in that. And BETS was probably the first one who offered this model, and which doesn't discriminate a sponsored access participant from a member firm. I do, when I read MiFID II proposals, the kind of latest leaked draft, and the ESMA draft guideline for system and controls, it does point to the direction that actually, that's more recent development, that they more look at exchanges as well. So, they look at the whole chain, the order originator, a potential intermediating broker, and the exchange. And there are some, historically there have been some exchanges who have always done at least like a little bit of risk check. So Deutsche Börse, for example, they've always done a like single order size check. Per trader ID you can define that, and you have to define it. And that's what every order is checked. So it's not much, but something important there. And there's a lot of systems out there which don't have anything like that. So I do expect that there will be more done on the exchange side, and it will be at least fair, hopefully, in terms of like latency. So all like sponsored access, member firms, etc., have faced the same latency.
How much? Just coming back to something you said, Neil. How much of a mismatch do you think there is between what the regulators are trying to achieve and what market participants and exchanges actually want?
I think it's a difficult one, because every regulation that gets introduced to create a fair playing field, there'll be a body of people out there who are trying to circumvent that so they get an advantage within the market. Be it a technical advantage, be it a quantitative advantage, be it just giving them something that somebody else hasn't got. So it's a very difficult place to sit, and I'm not saying that it's an easy thing for them to do. I think the main thing that we're looking for as a clearer, as somebody that provides trading members, non-trading members with technology and access to markets, is that a fair playing field is created. And as soon as you start taking the potential to have decision-making processes of risk, and you take them into the trading membership's capability, that's open to interpretation of how much they want to actually apply, how much of that rule they actually want to set up, and how many risk checks they actually want to adhere to. And it's very difficult for the regulators to go back and to actually check if those risk checks are actually being applied. So I think what we're really asking for is a fair playing field, and to create a model that is fair for everybody, so that we can go and offer a service to a non-trading member, to a trading member, that equals a trading member with their own technology, so they don't have that competitive advantage. I think in the low latency world, the very requirement to have a low latency infrastructure where you've got the ability at an exchange to buy capacity, to buy a low latency solution, it doesn't offer you a fair playing field. It offers a playing field that's open to the ability to basically buy a competitive edge. And with the risk modelling incorporated into that, it's open to interpretation of how much someone actually wants to adhere to it.
Is it such a bad thing that people can buy a competitive edge? Isn't that the way the market generally functions, is that the guys who spend more money on infrastructure and systems and putting things in place, they do that to gain a competitive edge?
I think the problem comes, though, that where you get to a certain level where it becomes almost impossible for somebody else to step into that marketplace. And that's something that we try and offer our clients who don't have the revenues, who don't have the balance sheet to be able to step into that environment. We offer them access into that, but it is an incredibly expensive world to step into. The exchange is now offering 10 gig connectivity, they're offering co-locations. It's a very, very expensive world to be in. We're just asking for that to be fair, so that we can offer our clients an opportunity to step into that market without being penalised for having to run additional risk layers that a trading member doesn't have to.
On the regulatory side, again, looking through the recent new stuff, which is the leaked MiFID II proposal, positively for high frequency trading, some things have disappeared. So there's no definition of like what is that. It is acknowledged to be just kind of a special setup, and you can do various things with a kind of fast trading setup. Things have disappeared that were there in earlier versions, like market making obligations for who would be deemed a high frequency trader, minimum resting times for quotes or orders, order to execution ratios, although they have kind of reappeared somewhere else, but so things which I must say had questioned have gone. And actually, asking a little bit about like what's the role of the broker in the kind of like high frequency world. An important role is actually talking to regulatory bodies and others, because we are kind of aggregating views across like many clients. I'm carefully optimistic that there's much more conversation going on with Esmine and AFME and other organizations. So I'm carefully optimistic that regulators get a better understanding. Leaving the regulatory side away, where I'm more optimistic than I was, for example, a year ago. It's talking about investments and the level of investment, etc. I think what people don't realize a lot is that it's not all about the latest hardware and connections and whatever. I think normally if you walk into a high frequency trading firm, people will talk or think about, okay, where do I get the next very bright employee from? Yeah. They're not spending all their time and thinking, where do I get the next best network card from, and so on. They think about the employees who create kind of ever more creative models, and this is where they get the edge from. And I think it's also a little bit like a step function that you always see. There's a certain like saturation in achieving a certain latency, and there's like a temporary equilibrium, I would say, where people get comfortable in a call it the moment like few microsecond world, and then that will stay there maybe for half a year or so, and then we jump to the next word, and then we all start to count in nanoseconds. But the moment, I do think it looks a little bit like a equilibrium, which is also determined by the economics, right? What is very expensive, like 10 gig connectivity on some of the big exchanges like Euronext or so, is expensive stuff, and but it's really the people, the brain, to come up with new models. And I think what you do realize in the most competitive markets in the US, there is a competition, and you can't run simple models there anymore. I can't rely on speed differences. Yeah.
I'd just like to stop there for the moment and ask if we have any questions at all from the audience on anything we've covered so far, or any comments or input on anything we've discussed. All hands down. Okay. Okay. Well, we'll continue. I mean, on the subject of cost, and also what your HFT clients, because you both have HFT clients amongst your wide range of clients. So some of your clients are probably a lot more latency sensitive than others. I would imagine that the guys who are doing pure HFT, their margins are shrinking. It's getting more and more difficult for them to compete with each other. How are you seeing their requirements changing? What are they coming to you and asking for now that they haven't asked for in the past?
I think one of the things that we're seeing now, which we haven't seen over the last couple of years, is that people are actually understanding their requirements a lot more before they go and look for technology, before they go and look for solutions. I think a couple of years ago, it was very much all about, we want the lowest latency, we want the fastest, we want the biggest capacity. And that was almost with no consideration to cost. until they actually saw the cost. And then they realised that, well, actually they don't need the fastest, they need the second fastest, because they can't afford the fastest. It was a simple answer for them. I think now what we're seeing is people are coming out and understanding that with a particular algo, they don't need ultra low latency. They don't need the ultimate in speed, because the algo isn't actually based purely on the speed. And I think the good thing that we're seeing now is much more of an understanding of their quantitative models, which is a good thing for us.
Okay.
Yeah.
Okay. So what we see recently, I would more say, next the last few quarters or so, is what has been talked about. It's sometimes funny. You see like conferences and they talk about something and everybody talks like, well, it's all there, but it's not really. It takes like 2 years or more. So that's really the theme of like cross asset class, higher frequency trading. So what people ask us specifically, that's where our sweet spot is. We give access to futures, options, equity, and FX trading, and then are able to kind of cross margin.
Yeah.
Again, with the different books, which makes it economically very interesting for clients, and can easily make it actually financially more viable than having your own memberships on all the individual platforms who all require their individual margin. So that's definitely something which is happening, and it's still like slowly happening. It's not, again, it has been talked about for a long time, but it's only happening now. It's not that easy. People who are like deeply rooted in the FX trading world find it difficult to get their hands on equities. Futures is more natural, and futures people find it equally as difficult to get into equities, and so on. So that's, I would say, definitely a trend. And
are you finding that your clients are increasingly looking to trade asset classes that they haven't done before, to find the alpha maybe that they're finding more difficult to capture in the existing markets that they're trading? It's diversification, really. I mean, we have seen, in the summer, we have seen a dramatic shift in liquidity profiles on all sorts of markets. Liquidity has dried up. In equity markets, order book depth has halved, if not worse. Spreads have widened. So for little trades, and with the increased volatility, you might think it's easier to make market, but it's not necessarily. And August is a different story than September. So the answer to that is, for a lot of our clients, is diversification models, to have the models ready, and even to have a good kind of shelf of models that don't work at the moment, right? That have worked historically in certain times and that you can't activate at the moment, but which are ready there to be turned on, and you turn off other models. That's important. How do you see the business models changing across the industry in terms of, previously, a firm was either an exchange, or was a broker, or was a prop trading firm, or was an asset manager. How are you seeing all of those relationships between those types of firms changing, and the kind of crossover between them as well, and the types of business models that these firms are operating?
I think if you look at the exchanges, for one, the exchanges have stopped just becoming an exchange, and now a proportion of their revenues are coming from technology provision. And if you look at more and more of the actual trading exchanges, they become a technology venue. They have a technology arm. They break out into providing co-location space, providing infrastructure, providing risk tools, providing potentially algorithmic tools, and so the whole kind of trading area becomes much more of a blur. Become clearing houses, So from that side of it, people are looking at much more of a market share. They're not happy to stay in the little kind of niche that they had before. And you have to question the co-locations. Do they exist because they provide valued liquidity within the marketplace for the whole segment? Is that liquidity really there from the HFTs for the HFTs? And it's kind of almost like a little club that you have to be in to gain advantage of that liquidity. And then the second thing is, are those co-locations there because they just provide a revenue generation for the exchanges? What's the real advantage of those co-locations? You move the servers close to the exchange. Technically, you may not gain a trading advantage if everybody sat 2 miles away, but the exchange gains more of the revenue from the exchange provision. And so you're seeing now that more and more of the exchanges are wanting to provide more and more of your service, wanting to provide a greater service to their clients to capture more of those revenues. So they're buying independent software vendors, they're buying technology platforms, they're buying or creating data center spaces because they can see that there's value out there, there's value that money's going into that they want to try and take part of.
But there's an increasing number of data centers and co-location facilities that are sitting half empty, I would imagine. What are your thoughts on that? I mean, is that likely to change? Have the exchanges and the firms who set up co-location centres over-invested?
I think if you look at some of the larger data centres that sit out there, as you say, half empty, and then you start hearing of they're providing general hosting space for other business types. I think a lot of those were built on the 2 year ago hype of we have to have low latency, we have to have co-location, and they took a punt. And they've now got a massive data center space sitting there, half empty. I think it was a punt that particularly, potentially went wrong for a number of exchanges.
Have you got any thoughts on that, Hans, on the use of co-location?
No, not particularly on that. I mean, it's a business model. These are grown-up firms who have made their investments, and maybe they fill their data centers later. And if you follow the history of some data centers in London, they some of the exchange independent ones had a different history. They had a different client base. Interaction is a good example, and have only more recently become a premier choice for being in the middle of a few exchanges in London, and the client base has changed from media and other to financial firms, and I mean, running a business, a data center is well, actually, I'm not the expert on the business model, but taking your original question, how do business models change and so on. What I find interesting is, in the quant investing space, you definitely see that you have a breed of market-making firms. Some of them even rooted in open outcry days, which sounds funny for high frequency, but some algos are still based around human behavior and what dates back to open outcry, which now is taking place on screens, essentially, but just implemented in a super high-tech way. So you have more rules-based shops. And on the other hand of the spectrum, you have the quants with models which take into account much more than just stock prices, and using all sorts of different forecast techniques from physics and other phenomena, and which you more find in quantitative hedge funds than in prop trading firms, and they seem to kind of get a little closer to each other. Because margins and what is what it can produce alpha kind of is more changing, and it's more unstable, I should say. As I said before, in some market phases, some models work much better than others. So you definitely see that the more traditional market making firms are trying to hire the mathematicians and so on from kind of the more traditional quant space. And the quant space has realized, like, if they apply their models on like shorter term horizon, it might be less volatile, etc. So they're getting closer to each other, and definitely you find then also the shops who are like fully diversified and have like groups who do everything on that in that space.
Yeah. This might be a little bit off topic. We've been kind of moving around between topics a little bit here, but I'd be interested to get both of your views on this proposed financial transaction tax, which it's loosely related because we're talking about the roles of the big brokers and how the industry is changing. What are your views on if this financial transaction tax that we're talking about, the Tobin tax, is implemented? How will that impact, first of all, the trading, the whole kind of trading world, and then beyond that, business in general in Europe?
Yeah, so that question thankfully was answered by the impact report, which was published last week by the European Commission. Kind of on the same day the directive came out. And there's an 8-page summary which is readily available on the internet. I can only invite everyone to read the 2 last pages, which are kind of disastrous. It cost, it says there, I mean there are different models, but can cost up to 1.76% GDP for the whole of Europe. I think it's 70 to 90% of the trading volume will go away. To answer that question, it will cost 0.2% unemployment, extra unemployment, and so on. So it looks disastrous, but there are different scenarios, and there could within the impact analysis presented there, you could easily come to the conclusion, the money that could be earned net could be negative. So thank God this came out as well, which makes me feel that even if there are no politics around, so there's a good basis now for politicians to say, okay, well, no, that doesn't make sense, other than kind of our best bit that UK politicians will vote against it, right? But maybe there is, Merkel and Sarkozy dig out the golden carrot, that they might still agree. But based on this like impact report, I think it has a very low likelihood. Worst case scenario, say beginning of next year, first quarter or second quarter, when it's officially being voted on. Say all agree on that, right? So it will become effective beginning of 2014. So that leaves us with 2 years of preparation time, all of us, to decide like where do we want to take this trading to. Obviously, it depends on the small print of the then final directive, but we might be able to take a lot of the trading to Dubai or wherever we decide. There will definitely be countries in the world who will not implement that. Relatively certain about that assumption, and as history has shown before, financial flows are very fast, but not everything can move, right? I mean, the central custodians, where really the shares or the electronic representation of the shares are lying in each country, you can't take that away. Right? You can always write Delta 1 derivatives on it, but obviously there are investors who just need the real thing, the exposure to that share, and that's the only thing which stays there. But there are, I think, all sorts of creative solutions, and I mean London is the best example, right? I mean we have the stamp tax, and everybody is still happy with how we trade, and it's the most liquid market, and so on. But I'm not saying that the directive is suggesting to implement a stamp tax which can be avoided or can be structured away, or you get your exemptions as easy. That's not the idea of it, right? I'm not saying that, but we have all been very creative around stem taxes, and there are examples where there's just no way around it, and there are examples where like certain investor groups can get around it for good reasons. So we will see. It is very political, and there are ways.
How would you see it impacting your business now?
Well, I think it's. I mean, I think that was very well answered. First of all, I think it's a brilliant example of how we need to stay very mobile in this industry. It is a very liquid industry. It doesn't matter how good your technology is, doesn't matter how good your business model is, doesn't matter how good your quants are. If you're not allowed to trade, or there's a huge financial penalty suddenly levied against your trading model, doesn't matter how good your technology is, it's no use to you if you can't use it. And I think the whole thing with latency, with HFT, is that it is quite a delicate area. It can quite easily, the balance can quite easily be upset by a legislation change, by a taxation change. People that invest in hundreds of millions of dollars in technology, in space, co-locations, in staffing. But you have to be aware that it's there's a finite length to how long that can actually be used to you, if you can't mould that into something new when a piece of legislation changes the way that you're actually doing your business. So I think, yes, it could be very disruptive to what we're currently doing. I'm sure that there'll always be a way around it. Everybody always seems to find a way around these issues. But I think it's just a great example of why we need to make sure that we're not in a 10-year, 15-year business model. It's a very liquid, mobile market, and you have to keep that in the back of your mind all the time when you're looking at investments in technology or staff or business models.
We've got a couple of minutes left for questions from the audience, if anybody's got any questions. Something at the front here.
Hi, it's Den Pilsworth from AHL in part of Man Group. A couple of points just for the panel to comment on, perhaps. First one, aren't we already paying a huge transaction tax in terms of the cost of all this technology and the fees taken out by the exchanges for co-location facilities like that? Second one, I haven't heard much debate recently about the ultimate economic value of taking order matching times down below milliseconds and into microsecond territory.
I think the first question is very easy to answer. Yes. I think you're right. I think if you look at the cost to trade now versus the cost to trade a couple of years ago, the costs are only spiralling, and at some point it has to come to a level where somebody says enough is enough. We're already seeing people who were very much in the low latency HFT space, who were prepared to spend huge amounts of revenues on infrastructure to support their models, now looking to save costs, now taking a step back and saying, actually, for us, enough is enough. There is no opportunity left in this particular space for us. So I think, yes, the costs are too high. Are they going to get cheaper? I think at the moment they're still going up. I think we're seeing that with the cost of infrastructure from exchanges being offered out, and although they are an option to take, I think in a lot of spaces you have to take that option to remain competitive. So you're no longer buying into, we're going to buy an advantage, you're purely spending additional money to maintain that place on near the front of the grid. So yes, we're paying far too much. And the exchanges at the moment almost have carte blanche to create these opportunities to take revenues out of clearers, trading companies, and members.
I partially disagree. We also have to disagree on the panel in one side. So, I mean, I think there are, I would like to differentiate between the exchange-run data centers and like the public data centers, right? And the Equinix Slough data center, which is the home of Chi-X and the home now of BETS, that is just another data center, or it used to be just another data center, and Chi-X chose it as kind of their data center to place their matching. They have to place it somewhere, right? And for any firm that has to put some more servers into a data center, you have to pay something. I mean, you have to make a decision tomorrow to place a few more servers maybe, and it could easily be that, for example, an Equinix rack is as expensive as another rack in another data center, and say, I think there are good examples where it may be just marginally more expensive because you have the presence of a big exchange, and on the other hand, you have the examples of Euronext and LSE where it's definitely more expensive. And there is a tax, but the more they lose market share, the more they lose the pricing power for their data center business. But also, I mean, looking at the LSE, of course, it's premier space in the middle of the city, so it's not a complete surprise. It's more expensive than Slough. Basically, it should be, by the location, should be pretty cheap. So Euronext, but it's not. Probably because it's brand new and so on. So I think that are different examples, and like Deutsche Börse is a good example that an exchange can move, right? They moved now, they have their own proprietary data center. You couldn't co-locate. They move into the Equinix data center with their matching. Oh, sorry, they have, the equity market has moved there. So so it's the same model as Chi-X. So on the data center side, I do partially disagree.
Okay, I think we've come to the end of our time, unless we've got a very quick question from anybody. Okay, well in that case, I'd like to thank Neil and Hans for joining us. Thank you.